Good morning and welcome to our monthly house view. The war in Iran escalated further in March with major disruption across the Middle East. Brent crude prices increased to close to $120 per barrel because of the closure of the Strait of Hormuz. So Marie, how do you see the situation in the Middle East and the energy shock evolving?
So first of all, uncertainties are high. We have the conflict that is spreading into additional fronts, including ground operation. And we have the net hit to global oil stocks estimated around 13 million barrels per day, if we include the pipeline redirection and also the release of strategic oil reserves. So we have, for the moment, limited sign of concrete peace talks between the US and Iran. And the interests between the two countries are really diverging. So the probability of prolonged oil and energy disruptions has risen further.
Given all the uncertainties and the dislocation on the energy markets, how this is translating into our macro scenario, specifically on the inflation and growth front?
So first, the energy disruption has led to an increase in energy prices, and this increase in energy prices is spreading to other sectors. For example, we have an increase in food prices through transportation costs or fertilizer costs. And this is also spreading to manufacturing costs. So for now, we are at a crossroads, depending on the duration of these conflicts. So the Goldilocks scenario is not our baseline scenario anymore. We increased substantially the probability of the stagflation scenario, and this is a scenario implying higher growth, higher inflation, and more hawkish central banks. And for example, the Fed, the ECB, the Bank of England, they already shifted their communication towards a more hawkish tone. But we think for now that the recession risk is limited.
So we have a very negative mix of higher inflation, weaker growth, plus geopolitical stress. How should it position portfolios today in this environment?
So persistent stagflation risks warrant a cautious stance on markets. Stagflation risks are headwinds for both equities and bonds. So in the beginning of the conflict, we reduced our equity positioning to underweight, and after that, we progressively continue to reduce. So we are underweight notably emerging equities and European equities. We also continue to reduce our sovereign bond positioning across all currencies because monetary policy conduct is constrained for central banks now. The resolution in energy disruption is key for any market reversal, and once we have this resolution, catch-up trades will constitute key opportunities.
Thank you, Marie. So to conclude, with heightened geopolitical risk and a lot of uncertainty on the macro side, we think that prudence matters. Reduce risk, higher cash buffers, selective exposures, and redeploy later in the cycle will define portfolios for the coming months.
Thank you very much and see you next month.
See you next month.